Welcome to the Wade Pfau presentation on reverse mortgages. Um, I'd like to first introduce Ryan. I think he's going to be taking lead here. Uh, would you like to quickly introduce yourself and you know talk about your background and what you're all about?
Yeah, happy to. I don't know if I'll get everything I'm all about, but I'll give you a glimpse. So I'll actually tell you a quick little story on how I became acquainted with Dr. Pfau, and he probably doesn't even know this, but my background, about 25 years in financial services. I've been in private banking, built a small hybrid broker-dealer RIA firm, sold it a few years ago, and have a nonprofit called Main Street Philanthropy that teaches life and finance through giving. We raise money and teach kids how to give it away, and got a call from some friends of mine that had gone into the reverse mortgage space. And they said, "Hey, we got this great opportunity. It's helping people with retirement." And I said, "What is it?" They said, "Reverse mortgages." And I said, "Oh my gosh, you're crazy." I threw up in my mouth and said, "No way, not my clientele. That's for people that are broke and you steal homes," and I'm out. And so they kept challenging me. And finally, they played a trick on me and said, "Will you just help us do the math?" And I said, "Okay, I like math, happy to help. I'll do the math." And so I started running the math on these things, and I was super intrigued. I'm like, this doesn't sound like what everybody's told me it is. And this could be really interesting. I don't think many people understand this. And so I said, if you guys are 60% right, we could be onto something really big. And so I decided to come help them build out some initial presentations. And they sent me off pretty early on to a FPA chapter meeting in New York. And I was on my way there. I'd build a beautiful presentation and send it to our compliance friends. And on the way to the airport, I found out that they couldn't approve the presentation, mostly because they had no idea what I was talking about. And I barely knew what I was talking about because I'd been in the industry for about a month. And so, we exchanged some colorful words. And I said, "Why am I doing this and getting on this airplane?" They said, "You'll be fine." And as you guys all know, if you have a presentation, you have safe guardrails, right? You can present, you've got slides, it's all good. If you have no presentation, I basically told them I'm parachuting into enemy territory with no weapons, no gear. This is not good at all. Well, it turns out before I had left the office that week before, somebody had handed me a book that looked a lot like this. It was an older version, but it was some guy named Wade Pfau that I'd never heard of and couldn't spell his name. And so I got on the plane and I said, "Well, shoot, this is what I've got." And so I realized I had 6 hours from San Diego to New York to learn this thing well enough to present to a bunch of financial professionals in New York. So I opened the book, read it cover to cover, opened my laptop and said, "I got to prove this math because I have an issue with what I call OPM, which is other people's math." And so I opened up my laptop, recreated all of Dr. Pfau's analysis, the sequence of returns, ran amortization schedule, figured out how PLF works, understood line of credit growth. So by the time I got to New York, I had a very unique and deep understanding of how these things work. And it ended up completely blowing my mind and realizing that this could be one of the most misunderstood, underutilized tools in retirement today. And so, Dr. Pfau, thank you. You saved my bacon. I arrived there and I had an understanding. Had I not had that book, I don't know what I would have done. Some song and a dance. And my colleague here, Hank Sanders, was with me on that trip, and it turned out beautifully. Large part thank you to you for helping me understand the core mathematics of how this thing works, which I think is just a missing art in this whole industry. So appreciate you for that.
Oh, well, thanks. And yeah, I understand that point about other people's math, because my first efforts at doing it was to see if I agreed with some of the math of the early Barry Sachs and his brothers research, and then Harold Avinsky and John Salter out of Texas Tech, recreating their research and checking their math. And it all panned out. So
and it works. Yeah. So thanks for that. So Corey, do you want us to just jump right in and start having a conversation? Anything you wanted to tee up?
Yeah. If you've got questions that you'd like to ask, please post them into the chat, and we'll get them asked of Dr. Pfau or bring you into the conference and have you ask them directly. Ryan, you kind of want to lead off?
Yeah, I'll get it going here. So again, Dr. Pfau, thanks for joining. This is fun. Everybody in this industry hears a lot about you, and an opportunity to hang out to you is an honor. So I'm glad that these guys allowed me to come and do this interview with you. So I appreciate that. So kind of along those lines of the great misperceptions, I'd love to get your thoughts on, what do you see and hear as the primary things people misunderstand? And as an example, I know as this webinar was being presented and marketed, just within the chat stream, people are downvoting and saying, oh, these things are awful. And most of them really don't know what they're talking about. What do you see as the great misperception and misunderstandings for consumers, and maybe even more so for financial professionals in this space?
Mhm. Well, yeah, I think certainly probably the biggest, well, the main misconception is just this idea that you lose the title to your home as part of the process. But beyond that, everyone's always wanting to look at reverse mortgages in isolation. And so then they note the upfront cost, they note the growth of the loan balance, and then it looks expensive from that perspective. But the problem with that is, how does the tool integrate into a retirement plan? People need to spend money in retirement. Where will that money come from? And what the research that you were replicating, that I was replicating, has consistently showed in article after article since about 2012 is you can create synergies to help protect other assets so that once you pay the fees, you still have a better outcome, that there's a net positive outcome by strategically using a reverse mortgage in retirement. And that's, I think, really the main point that gets misunderstood. People don't recognize how risk changes when you retire and are spending from assets. And so therefore, they don't appreciate how a tool like a reverse mortgage can actually have a positive impact net of fees to create a better outcome and to serve as a risk management tool for that retirement strategy.
Yeah, good. So two interesting things come up in there. One is the fee conversation, which is always, everybody's scared to have that. And it's funny how often having conversation with advisors, you just show them what they are and oh my gosh, I've never actually understood how these are, how they work, because nobody wants to talk about it. My experience is you're better talking about stuff than not talking about it. So in that conversation, people tend to compare this to the mortgages they're used to, and it makes it sound expensive. How do you view the price relative to the value of a reverse mortgage, and really specific, it's a mortgage insurance premium? That's kind of the one big bugger that people have a hard time getting over. How do you tend to describe that to advisors, and really what you get for it? What's the value of that?
Right. It is important to make that distinction about the mortgage insurance premium, since it is the biggest upfront cost with the 2% of the home value. And it creates a lot of potential advantages. I like to explain it more as, this is an insurance premium that can lead to a lot of benefits. If everything goes great in retirement, you may never actually have to tap into the reverse mortgage line of credit. Then you paid an insurance premium, but you had this protection. And in those protections, with the reverse mortgage being a non-recourse loan, if you do need to spend from the line of credit, and if the loan balance were to exceed the value of the home, you do not have to pay back more than the appraised value of the home. And so if the home declines in value, it's kind of like a hedge of protection on your home value in that regard. And it can't be frozen or canceled. That's another question that comes up commonly, is why not just use a traditional home equity line of credit? Well, there's important differences if you're using this as a backup tool to help manage retirement risk, because if there's a market downturn, which is a significant retirement risk, a traditional home equity line of credit could be frozen or canceled. And so those insurance premiums are helping to protect that. They're also helping with the 10-year payment option, which continues for as long as you remain eligible, even if it uses up the entire principal limit of the reverse mortgage. So there's a lot of value that's created by having the insurance to protect access to those funds and to limit the potential impact of that access if the loan balance grows too high relative to the home value.
Good. Yeah. The home equity line of credit's always interesting. That's often the go-to. Right now, in my planning practice, everybody got one of those as the emergency vehicle. And then you have to ask, we went through 2008. Did you or anybody have one of those in 2008, and how'd that work out? Right. And even in the beginning of this whole pandemic, we saw banks freezing and stopping home equity lines. So, this is my nest egg thing becomes a challenge. So the other thing you brought up there in a minute ago was this transition that happens from a planning perspective as you move from what I would call the accumulation phase of life into the distribution phase of life. I think a lot of people don't fully appreciate the change or the complexity that occurs when you have to transition those planning strategies. Both advisors kind of do, but even more so consumers. What advice would you give to advisors and or consumers as they're considering what type of things they need to be aware of, or what type of kind of planning things change as people move from accumulation to distribution?
Yeah, the retirement problem becomes more difficult because in accumulation, you're spending from your salary. Like you're working, you're spending, hopefully you're setting aside a portion of that to save for retirement. But in that context, you're focused more on like long-term market growth and long-term market returns. If there's a market downturn and you're still saving, you get to buy more shares with your savings. And so you can actually benefit from short-term downturns in the market as long as it eventually recovers. But when you get to retirement, a lot of things change. You no longer have the salary. So you have to now think about, how am I going to fund my spending when I don't have a paycheck, when I don't have that salary coming in? And I have to figure out, how long do I need to make the money last? My life expectancy could be 20 years in retirement, but if I'm someone who's worried I might outlive my assets, I start having to think about, what if I live into my 90s or beyond? So I don't know how long I need to stretch the money out. And then I have to face this idea of sequence of returns risk, which is, if there's a market downturn, I have to sell a bigger percent of what's left to meet a fixed spending need. And that can dig a hole for my investment portfolio, that even if the overall market recovers, I don't get to benefit from that market recovery. And then I have, again, we don't have this salary or paycheck anymore, but there's all these potential spending shocks that exist pre-retirement as well, but post-retirement with the long-term care needs, greater risk related to healthcare expenses and so forth, where I may also be worried, do I have enough reserves available to manage unexpected spending surprises in retirement? And so these are the broader set of retirement risks that I have to be thinking about. And the accumulation base, just focus on the investment portfolio. That's not the whole story. Some people will be comfortable doing that, but there's a lot of tools available, the reverse mortgage being an important one of these, to help manage the risks to that investment portfolio when getting to that distribution phase of life.
Cool. And along those lines, how do you see reverse mortgage playing in to offset those risks? You mentioned earlier that it's essentially a risk management tool. What do you see as some of the key risks that this reverse mortgage can solve or help people out with during that retirement phase?
It can help to prolong longevity for the investments and to make sure that those investments are available by either the idea of sequence of returns risk. If there's a market downturn, when I have to sell a bigger share, that creates harm for my portfolio. If I can spend less from the portfolio, that really creates synergies to help let the portfolio grow and recover from any sort of market downturn. So I can either consistently tap a portion of spending from the reverse mortgage, which reduces the distribution need for my investments and helps those investments to last for longer. Or I could do a more coordinated, I call it a buffer asset type approach, where I'll have the reverse mortgage line of credit growing on the sidelines. And if there's a market downturn, or however I define how I'm going to do this, if my portfolio looks to be in trouble, I'll temporarily pause taking distributions from the portfolio. I'll draw my spending needs from the reverse mortgage. And then that can give the portfolio more opportunity to recover and to not lock in losses, not realizing that sort of sequence of returns risk. Or I could simply open the line of credit, let it grow, and have a good likelihood that I'll have access to a lot more funds in the future to manage spending shocks in retirement, versus waiting until I might need it for the first time and then opening the reverse mortgage at that point. There's this growing line of credit that we should probably talk more about as well, that is a huge advantage to being strategic about using the reverse mortgage throughout retirement, rather than saving it as a last resort if everything else has failed at that point.
Yeah, so I think what you just alluded to, the growing line of credit, I think is probably one of the most misunderstood, poorly articulated features of what this instrument can do. And by the reverse mortgage in some ways, I think we've done a poor job of explaining it. Advisors don't seem to understand it well. And I think it is one of the more interesting aspects of this. So talk a little bit about that growing line of credit, how it works and why that's such a unique feature within this reverse mortgage instrument.
Yeah, so financial planners are always figuring out ways to, I wouldn't say necessarily game the system, but finding creative strategies that work within the rules of something to get better outcomes. And so the growing line of credit, I think when government policymakers designed how the HECM would work, the home equity conversion mortgage, reverse mortgage, how that would work, they assumed people would open the reverse mortgage because they want to borrow from it. And the really interesting planning implication is you can open the reverse mortgage, and you do need a minimal balance to keep it open, say $100 or so, but the rest can be line of credit. And then the line of credit grows at the same rate that the loan balance would be growing, such that in the third edition of my book, I did this over historical data since 1890. There's a 60 to 80% chance that you'll have more access to funds. I compare opening it at age 62 versus at later ages. If you open at later ages, you get a higher borrowing rate because you're older. Hopefully your home has appreciated in value, so you get a higher percentage of an increasing home value. So there's a benefit to waiting, except opening at age 62 and letting that line of credit growth take off allows you to have more access to funds 60 to 80% of the time in the future. Plus, there's what we've seen over the last couple of years is this idea of refinancing. As home values shot up, as interest rates further came down and increased the borrowing rates on the reverse mortgage, the principal limit factors, you might be able to then refinance. If you're part of that 20 to 40% of the time that you would have been better off waiting, well, you can simply refinance. And so you get more access to funds by opening it sooner, and usually just being better off that way, but then maintaining that option to refinance if it would have been better to wait. So you still get that better outcome. You get more access to funds by opening it sooner and letting that line of credit grow with that adjustable rate or variable rate HECM.
So in that example, if you're an advisor designing plans, is that something you say, okay, at 62, we should be looking at this, understand if you qualify, and really the math is telling you that the vast majority of the time, don't wait until there's a need. Let's get this in place, start that compounding growth, and that will grow over time. And again, continue to give you increased access to equity. And as you mentioned earlier, hedging out the risk of real estate, because now you've got that growth rate started. We see a downturn in real estate and you're in a better position.
Yeah, once you open the reverse mortgage line of credit, it grows at a variable rate that's independent of the subsequent home value. So if the home declines in value, you still have that same growing line of credit. And so, yeah, for most retirees want to stay in the same home. And for retirees who live in an eligible home and want to stay in that home, right, when they turn 62, that's a good opportunity to have that conversation and to see if perhaps as part of a comprehensive retirement plan, it might make sense to open a reverse mortgage and treat it as part of the strategic planning process of creating the best possible retirement outcome. And by best possible outcome, I mean in terms of meeting spending goals and still preserving more for legacy at the end, or just preserving assets for longer in retirement, however you want to frame it. But you're getting a better outcome by strategically using the reverse mortgage.
Yeah, so both the longevity of your cash flow, access to liquidity through that growing line of credit, as well as potentially more for the kids from a legacy perspective as you look big picture. That's pretty cool. So you mentioned a couple times the variable interest rates, that the line of credit is attached to a variable interest rate and it grows along with whatever that underlying rate is. So whatever you're being charged is what's being credited and is the growth rate on the line. A lot of people in this environment get nervous about variable interest rates. But it sounds like you kind of there's a pro and a con to that. Can you comment a little bit about, from a planning perspective, the pros and cons of being in a variable product?
Right. So the reverse mortgage is the one financial planning tool I'm aware of that benefits on an absolute basis by low interest rates. And it's because it's just simply a present value calculation. So when interest rates are low, you can borrow more from the reverse mortgage because you get a higher percentage of the home value, because the idea is the growth of the loan balance would at some point, I think policymakers assume around age 100, the growth of the loan balance reaches what the home value would be at that time. So you get a higher initial borrowing capacity. And then if interest rates are low and you're worried they may go up, if you're using it loan balance, your loan balance would grow faster, although it is a non-recourse loan. If you're using it for line of credit, then simply your line of credit is growing faster. And so it's linked to a short-term interest rate. In my book, the example I use is a 1-year treasury rate, but there's other options available too, defined in the contract. And then it's just growing at that short-term rate plus the lender's margin plus the fixed 0.5% mortgage insurance premium. So yes, if interest rates go up, the principal limit grows faster. That could reflect faster growth of a loan balance. But if you're primarily using for the line of credit, that would reflect faster growth of the line of credit. And so from your perspective, it's better to have a rising interest rate environment, which is not usually what people think about with adjustable rate mortgages.
Yeah. So from a math perspective, if I've got a $400,000 line and I owe 100 and my rates call all in at 5%, my loan's increasing by 5% on 100, but my principal limit of 400 is also compounding by that same 5%. So we get a spread between the two, thereby accessing more equity. So that to me, I think is one of the more misunderstood things. Now, in your math, when you're doing this, do you find a scenario where, so let's say you're using this for the sequence of returns risks. I've downturned in my investments, so I'm using my line of credit to buffer my income for that year. I then see a recovery in my portfolio. Is there a scenario where it makes sense then to turn around and pay down the line and kind of be going back and forth? Have you looked at it that way as well?
Mm-hmm. Yeah, people have that flexibility. You can make voluntary repayments. And when you do, you're shifting funds from the loan balance back into the line of credit. And so the subsequent growth is then more so on the line of credit, and you can reuse those funds later. So that is certainly an option. I have tested that sort of option. I made a big shift in the 3rd edition of my book. From most everyone in the past was using these Monte Carlo simulations of randomized stock and bond returns. I actually look at it with historical US data in the new edition of the book. In past editions of my book, making those voluntary repayments looked like a pretty reasonable option. For the case studies in the new edition of my book with historical data, I found it wasn't necessary to make voluntary repayments, that ultimately you're better off just not worrying about making voluntary repayments. By using the line of credit to help manage the retirement risk, you've got that benefit. Your portfolio is going to have that better sustainability. You don't necessarily need to worry about making voluntary repayments at that point. But you
can. Is that mostly a function of just interest rate arbitrage? I'm paying less on the loan than I'm getting return in my investments?
Right. You can think about it that way. And I guess partly with US historical data, the financial markets have done so well that usually you'd rather keep the money in the investment portfolio and not make the voluntary repayments. I think that's the function of the historical data is when you make the voluntary repayment, you're losing that potential subsequent market growth.
So going in the weeds a little bit on that. So if you were to make a payment, I know in this book you address a little bit around some of the potential tax deductibility. And without getting too far down on acquisition indebtedness, in order for the interest to be deductible in the first place, do you factor in that benefit of, if I do make a payment, or I'm pulling, let's say I have an RMD and I'm making a pay down, I potentially have a tax deduction? Did you spend a whole lot of time getting into that, or does that get a little too weedy for some of this stuff?
I did not specifically include that aspect in my case study because I just had, I do, a new thing in this book is I do have a complete tax model, but I was assuming they were taking the standard deduction. And I don't think I had them ever paying a significant enough voluntary repayment that they would really go above their standard deduction. So I didn't specifically model that aspect when I was looking at voluntary repayments. But you can, strategically take advantage of that tax deduction, doing deduction bunching strategies and things to make sure maybe there's 1 year where you're able to get over the standard deduction. It's just these days it's harder to itemize. But if you're strategic around that, you might make a voluntary repayment, or this might really be more an issue for beneficiaries when they're repaying the loan balance, to be strategic around being able to take advantage of itemizing the, I'm sorry, as well in my case study, they weren't using it for acquisition debt, so they didn't have the option to itemize that anyway. But
So yeah, it has to have been a loan that was in theory refinanced, that was previously used for purchase or home improvement in order for the interest on that to be deductible in the first place. Well, that is an important feature for everybody to understand, right? So first, let's see if it's deductible. Then in order to get a deduction, you have to make a payment. And then in order to use a deduction, you have to be beyond the standard deduction. So there's some, but to your point, the bunching is interesting because you might do it every 2 or 3 years where you make a pay down, and now you've surpassed that standard deduction amount, and that could work. That brings up an interesting question. The last 2 years, we've seen a huge number of Heckam to Heckam refinances, right? More than we've seen in a long time because rates were low, home values were high. And from what I understand, and this, again, might get a little tax oriented, so humor us, everybody. But if you were to do a refinance, you're arguably paying down or paying off that previous loan. Might that also create a deduction for borrowers that refinance that property?
Potentially, for that acquisition debt.
Yeah, if it qualifies. So I always thought that's an interesting thing. As many of these we've done, have we effectively articulated that to people to make sure they're taking advantage when they've done these refinances? So whole interesting avenue there.
And with that deduction bunching as well, that might be a good opportunity in that same year to donate. If charitable contributions are important, do that in 1 year to a donor advised fund to be able to take a multi-year charitable gifting all in 1 year so that you can itemize that as well.
Yep. Okay, so I want to shift a little bit. We've been kind of in math land. And one thing I found with reverse mortgages and a lot of financial tools is, sometimes the math is the easy part, right? Because we can all do math, and this is pretty black and white. And what I found is that we can help people understand the math, but then they still don't do it, right? Why? Well, there's some psychological barrier that exists for people to overcome these. We have this notion of you must pay off your home, right? We have all these kind of ideas in our head that people have to overcome. I mean, reverse mortgage is bad, right? What do you think is a good way to address the psychological barriers, whether it's, and mainly even for advisors? If I'm an advisor and I get the math, I might be scared to bring this up to my clients because I don't want them to think I'm that guy that's trying to hawk the evil thing, right? So how do you help people overcome the psychological barriers of this?
Right. And that psychological barrier is, I've spent my whole life paying down my mortgage. It's finally gone. I feel that relief. The last thing I ever want to do is have another mortgage in my life. So the way I try to explain why you might think differently about that is just, the first point is the reverse mortgage. It is a mortgage. It's just, it works differently where there's not that fixed repayment obligation. You can push that back until the end. And so you don't get into the same kind of issues with having to meet those fixed payments as you go throughout retirement. So you don't have to think about it in the same manner. But then ultimately, the way I frame this is, like, when you spend from an investment portfolio, you're spending those assets, and then you don't get any of the subsequent growth that you might have achieved had you left those assets in the investment portfolio. Well, I really view the reverse mortgage as the same way of, instead of having this illiquid home equity that can't be used for anything, it allows you to spend from the home equity as part of the retirement spending plan. Now, there'll be a loan balance, growth of a loan balance on any spending from the home equity, but it's something functionally equivalent to missing out on investment growth on anything I spend from the investment portfolio. And so then, but when you open up that avenue to be more strategic and to coordinate, when will I spend from investments? When will I spend from home equity? Maybe I want to spend from both to just reduce the pressure on each. Then that's where you open up that ability of having the flexibility to just be more strategic and coordinated. And so it is a loan, it is a mortgage. You can't say it's not, but ultimately the way I try to explain the intuition to help with that sort of framing issue, to get over that psychological hurdle, is this is simply a way to spend from home equity in the same manner as you spend from an investment portfolio.
And what do you think are the greatest barriers that the financial industry has in making this part of just core offering? I mean, we've gotten into the whole fiduciary conversation, which maybe is another thing to address. Is, you know, is there some obligation? Is the risk not talking about it greater than the risk talking about it? But what do you think are the great barriers and hurdles that the industry has in starting to include this?
So there's a lot of different business models within financial services, and there's many financial advisors work with firms where the compliance department simply won't allow the conversation to happen, which is tough, because for the typical average American, home equity can be 2/3 of their overall asset base, not counting Social Security, but maybe the investment portfolio is 1/3 of their assets, home equity is 2/3 of the assets. And if you're advising on the investment portfolio, but not allowed to also incorporate a strategy around the other 2/3 of their assets, that makes it harder to build a good financial plan. So I think the compliance departments at firms are just worried because some of the negative media coverage around reverse mortgages, it may have been like a bad luck scenario where the reverse mortgage actually helped the individual didn't have assets at that point. The reverse mortgage helped kick the can down the road and allow them to stay in their home for a few more years, but ultimately it led to a foreclosure. The perception in the media of that is 80-year-old loses home to reverse mortgage, rather than 80-year-old did not have assets and the reverse mortgage allowed them to enjoy another 5 years before getting to this situation where they're running out of options. But that sort of negative media coverage, I think, is the last thing these financial, even though it won't really impact their financial plans, because we're not really talking about scenarios of individuals who work with financial advisors anyway, but that sort of negative media coverage creates so much concern that compliance departments simply don't want their advisors talking about it. And that's the biggest hurdle of trying to get them to be open to the conversation and to look at the research and to understand that reverse mortgages, when used strategically, can help create a better outcome. Another misconception there is this idea that FINRA is against reverse mortgages. They wrote a report and they gave it a negative title. It's called Reversal of Fortune. But Barry Sachs convinced them that in the original draft of the report, they were saying to only consider a reverse mortgage as a last resort. And he showed them how that was the wrong way to think about it. And so they removed that language. The report still says, understand what you're getting involved with, understand the risks. But the report is not against reverse mortgages. And I think too many financial advisors just assume that it is. It didn't get a lot of coverage when they changed the contents of the report without actually changing its title.
That's usually how it works, right? It's a lot easier to sell the negative version than it is the positive one. I think there's been a fair amount of that. And that's the kind of thing, as somebody losing their home, you fail to mention that, yes, they benefited from this thing for so many years prior to that. Along those lines, for advisors, one of the gaps I've seen is, to be able to illustrate this. People can read it and read academic studies, but how does this apply to me? How does this apply to my clients? I know you've worked on some stuff, and I know there's other people working on some things. Do you see a gap just in tools, software, ability to illustrate the with and without type of modeling, and where do you see that going? What is there a future in that space? Is there a need for that? Do you see that as a barrier? Just some type of software illustrative tools that can show this more effectively.
Mm-hmm. Yeah, so a big problem with existing financial planning software is it can't model dynamic scenarios, which is just where you change your behavior based on what those simulated future returns are doing. So most of the research in the reverse mortgage space was about these coordinated strategies, where it's like Barry Sachs' version is, if the market was up in the previous year, spend from your investments this year. If the market was down in the previous year, spend from the reverse mortgage this year. Well, there's no commercial planning software that's really able to incorporate that type of dynamic approach. But we have seen other development. So you can model some of the strategies. You can model a 10-year payment. Mm-hmm. You can model it. The general financial planning software might still struggle to keep track of the loan balance associated with that, but you can model a 10-year payment. You can model refinancing a traditional mortgage and taking that large fixed expense of mortgage payments out of the early retirement years, and how that helps manage that sequence of returns risk. So I think you can work with it with existing software, but if someday a company is actually able to produce a way to dynamically illustrate these strategies, which can, like, I have to write my own computer code to do that, but I don't have a commercial planning software. I just have to go into the code and change the coding.
A whole bunch of
model
if
different
equations,
scenarios.
right? It's a lot of if equations in it. You're essentially
Right.
recreating a Monte Carlo, thousands of iterations. What if? So that's
If this
yep.
happens and that, and then it gets complicated because you can only use the reverse mortgage if there's still borrowing capacity left. So if this and this and this are the case, then do that. And absolutely, it's not in the commercial software yet.
Good times will probably needs to be done. So something to look forward to in the future. What else do you see as, if you're looking at the reverse mortgage industry and planning, what do you see as maybe some innovations that need to take place? That maybe being one of them, but what are some other things you see as far as the management of an existing reverse mortgage? And we talk a lot about getting somebody in one. What about managing it when you have it, or even exiting a reverse mortgage? Anything you've addressed there or looked at as to key strategies along the way or at exit of the reverse?
Well, that is of course a very important point. When I do the simulations, I do generally tend to assume they'll stay in the home through death. And so it's just a matter of then, as part of the estate planning process, the beneficiaries or heirs have a year to manage that process and decide what they do. And I assume that goes relatively smoothly. If they wanted to keep the home, they could refinance into a traditional mortgage, or they could simply sell the home and pay off the loan balance and keep any leftover. Or if the loan balance exceeds the value of the home, they can do the deed in lieu of foreclosure and not have to be worried about actually selling the home. So I do tend to assume that goes relatively smoothly. I think that if there's not a lot of consumer complaints, like the Consumer Finance Protection Bureau looks at this and finds complaints about reverse mortgages don't exceed their relative percentage compared to traditional mortgages. But when the complaints do come in, some of them are just related to people not understanding how they work. But when there are more legitimate complaints, it does tend to relate to the servicers. And so it is important to make sure the servicing process goes smoothly and that the servicers are doing things the right way.
So I'd be curious your idea. There's this whole world. So we've talked a lot about the home equity conversion mortgage, which is the government created FHA insured version of a reverse mortgage. But that's not the only reverse mortgage in the marketplace. There's a lot of private lended or proprietary reverse mortgages. I'd be curious your comments on the validity of those. Are those things that people should be looking at, as well as, when do they come into play? And do you see more innovation coming in that space? What might that look like, and where do you see happening in that industry?
Yeah, that's an important area. So I included a section on that in the new draft, or the new third edition of the book, because it is growing in importance. Those proprietary reverse mortgages can be options when the home values are significantly higher than the reverse mortgage lending limit, which this year is the $970,800. So if you have a $5 million home, maybe you still have $1 million mortgage on it. You might not be able to get the full effect of what you're looking for with the HECM, but there are proprietary options that can manage potentially a home value up to $10 million, a borrowing capacity of up to $4 million. Can also be done at ages, it's on a state-by-state basis, but in some states, as early as 55 or 60, you might be able to use a proprietary option versus 62 with the home equity conversion mortgage. The proprietary options are non-recourse loans as well, but they don't have the government insurance. So on the one hand, that means you don't have to pay insurance premiums. But on the other hand, that means the lender is taking on greater risk because they can't benefit. If it becomes into that non-recourse scenario, they're on the hook for the fact that they don't get the full repayment instead of being able to draw that from the mortgage insurance fund. So that's where interest rates may be a bit higher. the borrowing rates may be lower, but we're seeing a lot of innovation there. There's even that you're generally not going to see a line of credit with the proprietary option, but there is now one firm out there with a limited one for the, I believe it's the first 10 years, or maybe it's the first 7 years. And don't quote me on the specifics, but there's a line of credit available temporarily. And I think it had a 1.5% growth rate per year. So it's much less than the HECM program, but because of the risk taken on by the lender, that's an innovation. You can't just have the full line of credit growth like you have with the HECM because there's no insurance to back that up. So I think we are seeing a lot of interesting innovations there.
Yeah, and maybe more to come. I think that one is, I think American Advisor Group has one. It's a 1.5% growth for 7 years, but the credit line's in place for 10. So I think you're right.
Oh, okay. Okay, that's what I was making.
That's pretty much what you said. Yeah, that's about what you said. So yeah, so that is an option, but not quite as cool as the HECM, but it's starting to get there. I've always wondered if part of the issue is just around volume in the space, right? There's just not enough volume to really justify putting a bunch of money into creating proprietary products. So it's sort of on the industry to, get more market penetration to be able to make it worth that extra effort. So I'm going to take a quick pause for a second. Corey, I want to see if we've got some questions that have come in. I've got plenty more, but I know there's a lot of people here listening that may want to chime in and have a chance to speak a little bit with Dr. Pfau.
Yeah, we've got a number of questions. Let's see. We're going to start with Mr. Nelson. Can you talk about the benefits of paying off an existing mortgage and the benefit to the portfolio in the long run by retiring an existing mortgage using a reverse? People seem to be going into retirement with a lot of mortgage debt.
Mm-hmm. Yes, I do have a whole chapter about that in the second and third editions of the book, because that is the most popular use in practice. It's more and more Americans are entering into their retirement years with a traditional mortgage. That creates sequence of returns risk because it's the early retirement years that matter the most. Like what is going on in the financial markets in the early retirement years? If I have this large fixed payment obligation in the early retirement years, I'm more exposed to the sequence of returns risk because I'm more exposed to a market downturn setting me off on a bad course. Even though that mortgage payment will end at some point, it can create a lot of damage for the portfolio. So I do tests comparing, what if I refinance a traditional mortgage into the reverse mortgage versus what if I just pay off the traditional mortgage with cash versus what if I just continue to make those mortgage payments in retirement? And you do see that risk management technique. More often than not, you're going to have higher net legacies at the end through the reverse mortgage refinancing. Mm-hmm. And when you don't get the better outcome, it's usually because like markets do very well, so that it's in scenarios where you don't have a super great market environment for that retirement, refinancing the traditional mortgage into the reverse mortgage gives you a better outcome consistently to be able to meet your spending goals and to not run out of assets, to have a better shot at meeting all your spending goals than if you maintain that traditional mortgage going into retirement.
Very good. Donald asks, I'm curious about writing off the interest on an adjustable rate. Like, what if I waited 5 years and then made a payment?
And that kind of sounds like that deduction bunching type strategy we were discussing, where if you were thinking to make voluntary repayments, you can only get the interest deduction in the year that you actually make the payment. So you want to be strategically thinking about, and there's also an ordering of, because there's mortgage insurance premiums, there's interest, there's there's what else is there? Oh,
principal, yeah, and maybe servicing, yeah.
Yeah, and then so there's an ordering to that, and you have to make sure, probably by working with an accountant, that you're getting that sufficient portion of interest that you're looking for to be able to make that deduction. And that sort of doing it every several years provides that tool for deduction bunching and being able to get over the standard deduction.
Okay. Gil asks, can you do a reverse mortgage with bad credit, and do they have to pay their debt, or do a no cash out reverse mortgage with no payment?
So there are financial assessments now. That was an innovation in about 2015. It's not as rigorous as some other types of financial assessments, but what can be done? So if people are not in a great financial situation, the idea is to make sure they have resources to maintain the basic homeowner obligations and pay their property taxes so that they don't have to be foreclosed upon. So as part of that process, it may just be you create a life expectancy set aside that allows you to make those ongoing homeowner obligations so that you can continue to live in the home. So that might be one scenario where someone really wants to stay in the same home, but they're worried they may not be able to pay their property taxes. The reverse mortgage could provide a resource for being able to do that. So it is still possible even with bad credit or with like bad financial circumstances. It's just now there are these life expectancy set aside carve outs that you can't just spend it on whatever you want, but you can spend it on that specific homeowner's obligation.
Yeah. We had an interesting case recently. Very, very wealthy client owned his house free and clear, and it appraised for $20 million. He put a reverse mortgage in place, I believe for 12 million. And his thought was that the house has appreciated so much over such a short period of time that he would, over the next few years, see a serious decline in the value of that home. And he estimated it would drop back to its, prior value of about $8 million. So essentially, he used a reverse mortgage as a hedge against downside risk in the value of his home. Do you see that as a valid strategy? Should we be focusing on that potential risk hedging more?
Yeah, it's certainly a valid strategy. Like if you have been in the scenario where you think your home is significantly overvalued relative to what may seem reasonable, absolutely, if you want to do that sort of strategy, and if by taking out $12 million in that scenario, and then even if you just invest that in some sort of safe like treasury bond or something and grow that with interest, you could do that as a hedging strategy where if you really are worried the home might drop to 8 million, then you've got that protection for yourself and you're able to access more of that home equity than you would have otherwise ever been able to do.
Do you see that strategy being used on a widespread basis, or is it just this one very, very savvy individual that's done it?
So that was certainly one of the proprietary options that I don't focus on as much, but yeah, within the HECM world, I have looked at that sort of approach. There was a big rule change in 2017. It used to be because when financial planners figured out this line of credit growth, I was estimating that in 20 years, there was a 50% chance the line of credit could be worth more than the value of the home. So they reconfigured some of those parameters. It's no longer anywhere near as likely, but it's still the case that yes, you have that hedging principle. And if you live into your 90s, and especially if your home loses value, you have a good shot at having a larger line of credit than the home is worth. So that is absolutely one of the considerations or potential uses of a reverse mortgage.
Yeah, it's such a cool product. And so many different ways to use it. We also see them being used in purchase transactions as well. They're taking their cash, holding on to it, and still getting to live, payment free forever for the rest of their lives. Very cool.
The HECM for Purchase program, I've compared that to if you're looking to buy a home, you could pay cash for the home. You could take out, I look at a traditional 15-year mortgage. You could use the HECM for Purchase. And it's consistently the same general story of, it's not 100% of the time that the reverse mortgage strategy wins these kinds of races against other strategies. But, you
Mhm.
know, 2/3 of the time, 70% of the time, the HECM for purchase is coming out ahead. And in particular, it's a risk management strategy. It's
Mhm.
consistently coming out ahead in the types of market scenarios where maybe the financial markets are not doing as well for your retirement. And so you do need more of that risk management and risk protection. It's consistently coming out ahead in those scenarios. And more generally, it's coming out ahead in the majority of cases.
So, is there any situation where a professional advisor shouldn't be looking at a reverse mortgage as a potential strategy for their retirement programs?
Well, it's not going to be appropriate for everyone because you do have to live in an eligible home.
Right.
I do think it's for people who are thinking to stay in that home over the long term. So if somebody's anticipating they're going to move in a year or two, it's probably worthwhile to just wait. In scenarios where one spouse is older than 62 and the other is younger, you might consider, there are eligible non-borrowing spouse protections, but you might consider whether it's worthwhile to wait until both reach age 62. And then also if the client, I talk about using reverse mortgages as a part of a responsible retirement income plan. If that client is somewhat spendthrift and may not responsibly manage having access to this large line of credit and may waste it on frivolous expenses, then in that scenario, they may be better off not having access to that home equity. So that would be the other kind of scenario where you have to make sure the client will use that responsibly as part of getting the best possible retirement outcome and not start overspending because they can, because they now have this money.
Yeah, I mean, and I think that's where we start to see people get into trouble. You know, they have access to a phenomenal amount of money and spend it irresponsibly. And then, you know, you start seeing all the complaints.
Mm-hmm.
Yeah. Ryan?
Yeah, I've got a question. Just I know we're getting close here, but I have a couple more questions that I think would be interesting. And in looking at the advisor landscape, are there one or two or three primary use cases that you're seeing are most likely to be utilized today? What are people getting most excited about, saying, "Oh my gosh, I could see now, and let's use this in this case"? What do you see as the most common use cases?
So that if for individuals who have a traditional mortgage at retirement, refinancing that into the reverse mortgage is the most popular use. And and it's a great use case for financial advisors whenever a client's entering into their retirement with a traditional mortgage. That's a great opportunity. Other use cases, so it's the whole portfolio coordination type strategy. Sounds like somebody's not.
Yeah, we've got someone.
Somebody with a stuffy nose for one. And maybe we can mute the rest of them somehow. Is there a mass mute?
But
Yeah.
Looking at the 10-year payment option or a coordinated strategy, in the third edition of my book, I came up with a really simple rule about when to spend from the reverse mortgage versus the investment portfolio, because that was an issue with the past research. It was complicated. The Barry Sachs version wasn't so bad. It was based on what the portfolio did last year, decide where to spend from. The Harold Evensky, John Salter, Sean Pfeiffer strategy was significantly more complicated, where you had to determine these glide paths of how much wealth you needed each year in retirement to make the plan work. And then based on where you are relative to that, making these decisions. I found that something that works just as well as anything more complicated and is easy to use is you simply note what was the value of my investment assets at my retirement date and just keep that number in mind. And in the future, if your investments are worth more than what they started, spend from them. If the investments are worth less than what they started, spend from the reverse mortgage when available. And so that's another potential use case. And then maybe the other one is Social Security claiming. I think a lot of financial advisors now understand that, especially for the high earner in a couple, it can be worthwhile in a lot of cases to delay claiming to age 70. But if they're already retired, how do they build a bridge to age 70? So a reverse mortgage term payment can be an option, and particularly if you then incorporate other tax planning. so that this can be a great opportunity to do strategic Roth conversions and things. And then the reverse mortgage can be used as part of that to help cover expenses, so that you do as much strategic tax planning as possible before Social Security begins and before required minimum distributions begin. And then even in cases where the client has a couple $1 million, if they've got this kind of window, they retired in their 60s, not claiming Social Security to 70, they might be in very good shape for taxes after required minimum distributions begin. They might even be able to get into scenarios where they don't have to pay tax on the full 85% of their Social Security benefits. And so that's another really interesting type of use case of helping to build the delay bridge for Social Security and thinking about how that also impacts the tax planning for that retirement.
Right. We have a question here from George.
Hi, thank you, Dr. Pfau. I'm a reverse mortgage loan officer, have numerous clients now. In our world, what's happened in the last couple of months, obviously rates have gone up dramatically. They have low fixed rate mortgages right now. And, trying to compel them, give them the proper sort of insight as to why it would be prudent to replace that with a reverse mortgage right now. Clearly to access maybe more money, but some other things perhaps as well.
Mm-hmm. Yeah, and so that's really, if they're retired or at retirement, it's really a function, not so much of the, like they may feel like they're benefiting from the low fixed rate, but in that regard, it's because they're thinking about hedging leveraging their investments. They believe their investments will grow at a faster rate than that mortgage. So taking that mortgage payment out of the budget could give them more of that ability. And it's not so much maintaining the low fixed rate mortgage, but actually taking that full mortgage expense out of the picture by shifting it to the reverse mortgage. If that's their thinking, that they're leveraging the mortgage to help their investments, the reverse mortgage can do that to an even greater degree and give you that low, well, for whatever is left over after the refinance, giving you that growing line of credit as well.
Thank you.
All right. We also have Mark, who has a question for you.
Mr. Pfau, I have a lot of times talked about the tax-free features that are involved with reverse mortgages. How does that equate to, at the end of the day with investments?
Oh, the tax-free aspect of as proceeds from a loan, it does not enter into the adjusted gross income. Yeah, that can have a huge, it's like a Roth IRA. It's when it's an asset you can spend from without adding to your adjusted gross income, which is an important issue because adjusted gross incomes are calculated before the deductions. And it's not just the federal or state income taxes that are impacted by adjusted gross income, but also things like, do you have to pay taxes on Social Security benefits? If you're a higher income person, do you have to pay higher Medicare premiums because your income is exceeding certain thresholds that lead to the IRMA surcharges on Medicare and so forth? And so having a resource that allows you to meet retirement expenses without adding to your adjusted gross income can, in these scenarios, if as part of a broader tax planning strategy, help that retirement immensely. People don't realize, I may think I'm in the 22% marginal tax bracket for federal income, but $1 of income, if I take $1 out of my IRA, I pay 22 cents on that. If I'm in a particular income range, that might force me to pay a net tax 22% on another 85 cents of my Social Security benefit. That might also, because the long-term capital gains rates have different tax brackets, that might also cause me to push $1 of long-term capital gains from the 0% bracket to the 15% bracket. So I may think I'm in the 22% federal income tax bracket, but even not including state tax, just federal, that dollar from the IRA might end up being taxed at 55% if it's also impacting Social Security and long-term capital gains. And that's where if I took that dollar instead from the reverse mortgage, I just save myself 55 cents of taxes. And that's where having that resource of tax-free income, what I shouldn't call it income, but tax-free spending resource can help with managing all these types of tax issues in retirement.
Thank you. I had no idea that it made that much of an impact.
It can, yeah. That's where if you're falling
Thanks,
into, it's
Mark.
called the Social Security tax torpedo. It's where a dollar of income also uniquely triggers having to pay taxes on more of Social Security. And so it leads to this higher marginal tax rate than you might have ever realized. And if you're in a state with state income tax, it can further compound these same things with the state income tax as well.
Thank you, Mark. Any final questions or wrap up?
I think we had one final question that was going to come either from Dan or Hank. A little bit about the future, or I can throw it out there. I don't know if one of you guys want to chime in.
Dan, hang on a sec.
Am I live?
You are.
Live and
Okay,
echoey.
fantastic. So Dr. Pfau, first of all, thank you for taking the time today to talk to ourselves, our team, loan officers, financial advisors. There's some realtors on board as well. I appreciate that. You reference in your book, though, my question would be, you reference in your book, there's 35 million people in the US that kind of fit the profile that might benefit from a reverse mortgage. And yet our penetration still seems to be at that 1.5, 2% of people out of that $10 trillion of equity they have. What would be your idea of how we as professionals in the industry could do this better? Right? At the end of the day, that's the $1 million question. How do we do it better? What do we do different?
Well, just to keep doing what you're doing, because there's so much just negative perception that it's hard to overcome that. And so just having to keep working at that. But right, what you're referencing there was a study by Mark Warshawski, who's at, I believe, George Mason University now. And so about 1% of eligible age Americans use reverse mortgages, but he estimated about 14% of those of eligible age Americans would actually get a significant benefit from a reverse mortgage. Now, you might say it's not 100%, but 1% versus 14%. There's so many people who could get much more advantage for their retirements by considering the reverse mortgage. And so just continuing to try to explain this and to help people get a better understanding. And it's just understanding how retirement's different, which is the whole issue. It's not, that's what we started with, this idea that I look at a reverse mortgage in isolation and I say, oh, it looks too expensive. But no, it's by using the reverse mortgage, all these other benefits I create for my other assets leads me to get a better outcome. And that's what we just have to keep pushing, this idea that retirement is different. We have to think about it differently. And when we do so, tools like reverse mortgages can look a lot more attractive as part of a complete retirement plan. So I just hope to keep doing that same thing and helping to educate advisors about this kind of concept.
Great. Thank you.
Mm-hmm.
Ryan, Wade, thank you so much for joining us today. I think we've run over by 3 minutes. I'm sure we'll do this again. And thanks very much for your attendance.
Thank you. Thanks, everyone.
Appreciate it. Thanks, Dr. Pfau. It's been a pleasure.
Thank you.
Yeah, thank you, Ryan. Yeah, thanks for the invitation.